Yesterday when we were talking about, Katie, I was in denial again, and not seriously in denial, but just wishing we didn't have to go through the inevitable pain that you're indicating we may have to go through. So you again are emphasizing we're in a cyclical bear market in a secular bull with perhaps more work in the averages to be done to make a real low. And now the important level on the S&P is back at about 3,800.
That's right. So I think we're all in store for a pretty rough summer, in fact, just based on the downside momentum long term. And we all want to relax, of course, but the market might not let us do that, unfortunately. We do still have those negative momentum gauges, intermediate and long term. The important support level for the S&P 500 is right around 3815. It's based on a Fibonacci retracement level, below which next support is around 3,500. So we're looking for this relief rally to end fairly quickly. There's resistance, as we've discussed, right around 4,200, so not very far from current levels, and that's based on the latest breakdown point for the S&P 500. Importantly, the S&P 500, even though it might feel it, it is not yet long-term oversold. That's looking at monthly indicators. So we still have some room to the downside. There are some areas of the market that are long-term oversold, but sometimes it can take a few months for that really to manifest itself in a nice base breakout.
So we go under, so 3815 probably does not hold. In your view, does 3,500 hold?
You know, I think worst case scenario is probably around 3,200, which is the second support. And that support would actually be targeted by a breakdown below that 3,815 based on the nature of those Fibonacci levels. 3,500, so it's not a highly important level, but it's an interim level. So I think somewhere perhaps below that, we'll see the market establish that long-term low. And in terms of time frame, we're looking out to maybe September, October as to a time frame in which we'd expect some improvement in our long-term indicators. So as it stands, they're all pointing lower. The short-term gauges are still mostly pointing higher. So looking at the market this morning, there's a very tight intraday trading range. And below intraday support for the S&P 500, it's roughly 40.90. That's where I feel like the relief rally might lose its hold. So we're really scrutinizing the short-term price action, trying to help people get hedged at the right time.
Go ahead, Andrew.
Hey, Katie, you know, one of the questions, and I know you were looking just at the data and just at the charts, but, you know, what happens if, you know, later this week we get PCE, for example, and it shows, you know, year over year inflation is down? You think the market would rally on that news? And so how do you think about sort of different data points that may come and how that could affect the charts?
You know, we think about it more in terms of the reaction, right? If the market breaks out from this intraday trading range in response to that news, well, then that, of course, is a bullish short-term development. So we really are more reactive in how we digest the data. And, you know, the market right now is reflecting all known information. And, you know, with that in mind, we just want to respect the trends and respect the momentum over different timeframes. So that multiple timeframe analysis is really key here, especially with everything so highly correlated. So short-term up, intermediate and long-term down. So it's very important to keep that in mind. So even if we get a nice positive reaction for that, you know, it might be short-lived.